this is just the beginning.
Welcome to the Future of Venture Capital virtual event. I'm Dan Primack, business editor of Axios, coming to you from my house in Southborough, Massachusetts. A big thank you to Pacific Western Bank, or PacWest, for making this conversation possible, and welcome to our audiences on Facebook and YouTube, Twitter, LinkedIn, and of course, Axios.com. Please follow along today with the hashtag Axios Events or @Axios on Twitter. And over the next 30 minutes, we will discuss the new normal in venture capital and how it's going to affect startup funding in America. And my first guest is Karen Norton, co-managing partner of Upfront Ventures. Hi, Karen. Thanks for joining us.
Hi, Dan. Thanks for having me.
Thanks for coming. So, Karen, the last time I saw you in person, we were on the field at the Rose Bowl for your firm's big kind of Los Angeles venture capital event. And that was right before all hell broke loose. So let's just start big picture here. As a venture capitalist, what's the biggest adjustment you had to make because of the pandemic?
I mean, I think the biggest adjustment is similar to what we all had to do, which is figure out how to work from home, from behind a screen, and do a job that's kind of very human in nature and very relationship oriented in nature. So, and obviously it's changed pretty dramatically from March until today, where we went from thinking the world was collapsing and every company was in a difficult situation to today, which is one of the hottest markets I think any of us have ever operated in our lifetime.
So, talking about being behind a screen, there was an old school venture capital mantra, which was, I'm not going to invest anywhere that's going to take me longer than 30 minutes to get to. In fact, I know a firm in Boston who used to have a certain number of subway stops. If it was past that number, they didn't invest in that startup. They didn't even take the meeting. It has COVID, and I know that's changed a bit even pre-COVID, but has COVID completely blown that up? Or do you still feel you would prefer to invest in a company that if something really happens and you need to get a cup of coffee with the founder, you can do it?
I actually think it's made us many of us much more open-minded about sort of first conversations we have and where we're looking at investments. I've always been of the hustle school. So, I grew up in the early days of Battery Ventures and Morgan Stanley, and we got on a lot of planes. So I've always been willing to get on a plane. But I think the flip side is 2 out of the last 3 investments I've made, all of which during COVID, have been done during COVID, have been in Los Angeles and Southern California companies. And I actually think community on the other side of this it's becoming clear that that's going to be more important than it ever has before. So I think it's different for everybody, but I actually think your edge or your advantage where you can do real relationship things over the long term is going to end up being more important coming out of this and not less important.
I'm wondering, the deals you're doing or the deals you're even looking at, maybe not doing, for true startups, Series A, even seed stage, new companies, how do you gauge whether these are groups of people, particularly a group of founders and maybe early employees, who are really going to be able to work together when they actually have to see each other every day as opposed to just have a few Zoom meetings? Because they're very different dynamics, for better or for worse.
Yeah, I think that's probably the biggest thing that is harder to tell over Zoom. I always say sort of, one of the things I look for in the early days are just the amount of, we always fund companies usually at their big seed stage or their early A stage. So call it, $2 million to $7 million type investments. And I always say the biggest risk is the amount of calories that you'll burn as co-founders, having the wrong kind of friction as opposed to the right kind of friction. And that's hard to tell over Zoom. So I do think that's an important thing to know. What I try to do now, because you can't really watch people in a room together, is I try to do a lot of one-on-one meetings alone with the different founders if there's multiple founders. And I just try to have, real human personal conversations, hear more about their personal life, things of that nature. It's imperfect, but I think it's a solution.
There's 2 schools of thought about startup formation during the pandemic. One is there should be more of it, in part because people were laid off. Maybe people are at home so they can kind of do side projects a little bit easier than when there's somebody over their shoulder. The other is you have a lot less serendipity. You have a lot less of those coffee conversations or, meet somebody at a networking event. Do you have a sense on kind of how you view the pace of startup formation right now compared to how it normally is?
Everything feels a lot faster, and you've reported on this a lot, and so I think the biggest difference is you have to be the kind of my word of the month or quarter is you have to be intentional. You don't have serendipity; it doesn't exist. You have to even be intentional about your serendipity. So my sense is more startups are starting really, in a positive way, like trying to solve big, real problems where, you can collaborate with people in different ways and get to know people, differently, right? You may not get to know them in person, but you can do 10 Zooms in 3 days and everyone's available and no one has anything else to do. Not necessarily good, but that's what's happening. Yeah. So I think you just have to be a lot more intentional about your relationship building and be intentional even about finding serendipity. And that's the part of the business I miss the most.
How do you do it? We've been talking about kind of investing and the business part of your business. But you're also a co-managing partner at Upfront. You run a firm that has partners and has employees and staff and all the rest of it. How have you viewed managing a firm when you're all sitting at home? Because normally you guys are, if not always in the same place, occasionally in the same place together and hiring.
Yeah, I think there have been ups and downs for every firm in trying to figure it out. And we're positive, optimistic people at Upfront, so we'll always look at the positives. But I'd say on the positive side, I have spoken to all of my partners at a much greater frequency. I'm on the than we would in a non-pandemic time, because you're on the phone with everyone every day. Everyone's available. No one's traveling. No one's commuting, taking their kids to school. But I ended up taking a walk with one of my partners a couple weeks ago, and it started out as a 30-minute walk. We ended up spending 4 hours together standing outside my home, and my husband said, "What are you doing?" And we obviously missed each other. So yeah. I think I think as in my new role, there are a lot of awareness around you can get caught up in all your to-do lists. We have this infinite supply of 5-minute to 1 hour to-dos, and it's really important for the people who, just to be thoughtful about reaching out with intention, not just around transaction, about rapport building, because we're missing the rapport building, and that I think we're always working on at Upfront as well.
Well, you mentioned at the top of this how a lot of us, including you, I guess, expected at the outset of the pandemic that we were going to get a slowdown in deal making and a slowdown in everything. Things ended up accelerating. The public markets have been insane with DoorDash and Airbnb both going public this week. What was the big miscalculation that everyone seemed to make in March? Or I guess the better question is maybe, why did things pick back up and get so hot given the macro circumstances?
I think the big miscalculation was that everybody was going to be affected in the same way by this, right? All industries, all people. And I think that the hard part and the sad part and the part we all have to work on is how we fix, policy in our country and sort of, the advantages and the disadvantages. And I don't think it was clear. And I think we were all just feeling maybe the weight of the pandemic on us as human beings. And now we're on the other side of that, where we're seeing all of these trends that we've all been looking at and investing in for a year, whether it's cloud and cybersecurity, food delivery, which obviously we have a big one coming out. I mean, Airbnb is one of the bigger surprises, right? Because we thought no one would be traveling, and it turns out, what happened to Airbnb is really is indicative of, I think, what happened to a lot of companies, which is a lot of companies that thought they would be impacted negatively actually became more efficient and really looked at how they're operating and really invested in culture and a bunch of other things that once demand starts to pick up, or as you think about a post-pandemic world, it was this massive change agent, and startups that do what startups do best, which is move fast against macro changes, are coming out of this much, much stronger. I would say not even just in the areas where everyone is rushing to fund productivity software and, video conferencing and cloud, et cetera, but in non-traditional, in places that maybe have been hurt, but use the time to get stronger and better to come out of this differently.
Is there a flip, when you talk about those areas that people have been rushing into, should there be, and from private market perspective as a venture capitalist, do you get worried about some of these things and think, they are particularly overpriced now because there is going to be a pullback. There's going to be a pullback on Zoom and on Peloton and these things in 2021, assuming that there's widespread vaccination, that we get back to, life as normal.
Yeah, Yeah, I mean, I love talking to all the growth investors now because I think it's a really good question for everyone, but in particular there. I think at the stage we come in, which is a seed or A stage, where we're trying to meet founders a year before they start something. We're trying to meet them in a very specific market in LA and Southern California. Pricing has gone up, but it's a very similar risk profile, and it's not gone up that dramatically, right? You can of the two investments I've made very recently, one was a sub $10 million post-money valuation, an early stage founder I built a relationship with over many years. The other was a mango seed. It's pretty expensive, but it's not all that different than when I funded OpenRaven at the seed round. And, you have the chief product officer of CrowdStrike spinning out. So I think it's really the growth phases where there's a lot of you have 2 weeks to decide. You have to be in front of it. You're not sure if this is good revenue or bad revenue. That's where maybe we end up having some unexpected consequences.
So, Karen, last thing, I want to ask you about geography. So you are in LA, and Upfront is known as kind of the Southern California venture capital firm. And not too long ago, we kept hearing about people from San Francisco, techies from San Francisco, CEOs, venture capitalists, who are moving to LA to get out of San Francisco. Now they're not talking about that. They're talking about getting out of California. So has LA already had its very brief moment as a pit stop as people get to Texas and Florida?
Oh, Dan, its moment is on the come. You can't ask me that question and expect anything but that. I'll give you a quick anecdote. In the last week, I've been sent, I think one of the great things about being upfront and being in LA is we get to roll out the red carpet for anyone moving down here, whether or not we fund them, et cetera. In the last week, I've gotten a senior executive from Dropbox, from Stripe, from Puppet. I mean, so I don't think it's about volumes. I think it's about people making deliberate choices around where they want to start and found their next company and set up headquarters. That is not slowing down. I've only seen it speed up.
So last question for you. How confident are you just in the local economy of LA bouncing back strong in 2021, given what's happening right now?
I mean, I don't know, man.
That is not very confident. That is not very confident.
Listen, we have one of the most diverse economies in the country. We have defense, we have aerospace, we have enterprise software, we have Hollywood, we have creativity. So I'm very confident. I think it's the home of entrepreneurship across all those categories. I actually feel I am as bullish on venture capital in LA as I've ever been, and I'm a naturally anxiety-ridden person.
Karen Norton, thank you so much for joining us.
Thanks for having me, Dan.
We're going to turn now. I'm going to throw it over to my colleague, Fabricio Drummond, for our View from the Top segment.
Thanks, Dan. It is now my pleasure to bring you a conversation with Sean Linden, President of Venture Banking at Pacific Western Bank. Welcome, Sean.
Thank you. Glad to be here.
Sean, 2020 was a roller coaster year for all of us. It was no different for the venture capital industry. Tell us, what's top of mind right now for Pacific Western Bank?
Well, first and foremost, I think the thing that we're most concerned about is making sure that all of our employees and all our other constituencies are safe and healthy and have a safe work environment to be in. And that includes in terms of the ecosystems that we work in, trying to make sure that we're being a good partner and providing help where we can. After that, I think that mostly we're taking a little bit of a wait and see approach to see how this continues to play out. I'm obviously very excited about the potential for a vaccine sometime here in the next 3 to 6 months. But mostly it's trying to continue to be a good partner in the areas that we work in.
Pacific Western Bank is a commercial bank with over $28 billion in assets. You lead the venture banking group. Why is venture capital so important to Pacific Western Bank?
So the venture banking division here at Pacific Western is really came about through the acquisition of Square One back in 2015, and then we rebranded in 2019. And the reason for the purchase was really for the bank to expand its footprint. Pacific Western has its roots in being a community bank, which is really all about relationship building. And venture banking is much the same. It's all about relationship building. And so we're sort of another offshoot to part of what the bank's trying to accomplish as a whole. And so one of the things that's important for the bank is obviously generating deposits. Venture banks have great ability to generate deposits over time. We've grown our deposits, within the division by over 40% this year. So that's one part of it, and it's also just part of continuing to expand the product offerings and the markets that we serve.
The pandemic has posed challenges for multiple levels of the economy. Like I mentioned, it was no different for venture capital. We've seen businesses struggling to make ends meet. How have you seen the pandemic affect specifically the venture capital industry, and how have you adapted the bank's strategy to support these businesses and clients?
So early on, back in the spring, I think like most other institutions, we, were very concerned, and we took a deep dive into our portfolio, across the entire bank, but definitely within the venture portfolio as well, to try and figure out where there were going to be hotspots and where we had concerns. Generally speaking, I think most of those have not really come to pass. Most of our companies have done actually very, very well. Throughout the pandemic, fundraising, as you know, has been pretty good throughout the year. Most good companies have been able to raise rounds, and even the ones that were more focused on D2C, or we had some that are facing the restaurant industry, for example, or hospitality, have still managed to find a way to work through these very, very tough times. I think a lot of that is an indication of how important the innovation economy is, not just for our business, but for the entire economy as a whole. And I think that a lot of the venture capital community took a longer term approach to this. They saw this as being, a short term hiccup's probably too soft of a term, but definitely as a short term thing to work through, a short term crisis, and have taken a long term approach to continuing to build, good solid companies that should come out of this, stronger than ever. We also have a fair part of our business that's in life sciences, and clearly a lot of those companies have really seen an increased emphasis or an increased realization of sort of the advantages and the opportunities that they create throughout our economy and society in terms of continuing to advance a lot of very, very new and novel technologies. I mean, the fact that we could get to a standing start to a vaccine as quickly as we did is just fantastic. And I think it's an absolute, all the people in life sciences deserve, a huge kudos for making that happen. So we haven't seen that much of an impact, to be honest with you. Most of our companies are performing by and large at plan and continuing to perform well. And I think that the reason why is that those are the companies that we've needed in these times. They're the ones that were helped, like Zoom and others, to help facilitate the work from home, to make us all safer and continue to move our businesses forward. And I think that a lot of the VCs have taken a longer term approach to the best companies will come out of this and be just as good, do just as well on the far end.
Another highlight of 2020, Sean, was the election. Be interesting to hear your thoughts in terms of how the election impacted venture capital, and also gather your thoughts in terms of what to expect from the incoming administration as it relates to financial trends.
Yeah, it's a dangerous question when you talk politics, but I think that more than anything, I think the most important thing is that, we now have the election behind us in terms of, now having certainty of what it's going to look like going forward. And I think it'll be interesting. I mean, there's a lot of stuff on the table right now. I mean, as you know, in the last 6 months to a year, the tech industry by and large has become sort of a hot topic in Washington again. There's a lot of stuff going on, whether it be the antitrust stuff or it be the way that the tech played into the overall election with Facebook and social media. So there's a lot of potential for things to change. But generally speaking, I think that whether it's the previous or the next administration, I think that they see the innovation economy as being an important driver for the overall U.S. economy. So I don't expect there to be a lot of changes. The big ones, that we look at too, we pay a lot of attention, as a bank, obviously looking at where interest rates are and what might be happening in sort of monetary policy. I don't think anything's going to change on that in the near term, just based on where we are in the economy, based on the continuing effects of the pandemic, which will probably be with us through most of next year. As I think you're going to continue to see a lot of capital inflows into venture capital, and because of a lot of inflows into the companies that we support and the companies that we work with. I also think that's going to continue to buoy up the public markets and the exit markets, as well as people continue to look for places to put money to work. So from that perspective, I think that we're pretty bullish on what the economy looks like and what the venture community looks like going through 2021.
And a lot has been discussed in terms of the way forward and rebuilding the economy. How do you see the role of venture capital in helping us rebuild the economy?
Well, when you look at where the innovation, look at where the economy is growing, you look at some of the things that are changing, it's very obvious that we need to move forward in terms of, revitalizing a lot of different industries. You look at things like Tesla and you look at some of these opportunities. I think it's pretty obvious that it's going to have to come out of the next wave of technologies that are going to have to create the next wave of jobs and the next boom to the economy. So I think it's critically important, and I think that a lot of people realize that at this point. And I think the venture capital community continuing to build great companies will continue to be a force for good in that.
Thank you, Sean, for such an insightful conversation. Thank you, Pacific Western Bank, for making this conversation possible. Back to you, Dan.
My next guest is Joe Kaiser, a director at Mercato Partners, coming to us from Salt Lake City. Hey, Joe.
Hi, Dan. How are you today?
Good. Thanks for joining us. Joe, let's start with this, which is I kind of want to talk about existing portfolio companies and portfolio management at the beginning of the pandemic. I think there was a feeling among a lot of venture capital firms that they were going to almost have to put a red line. These are the ones we're going to keep supporting. These are the ones we're going to have to let fight this out on their own. For you guys, is that how it played out, or was it more nuanced than that?
Fortunately for us, it was in our portfolio companies, it was more nuanced. We have a portfolio built of great companies that, at their core had strong unit economics. So we certainly saw companies come off of their 2020 plan, but fortunately, no existential risk in any of our companies. And in fact, we've ended up having four exits, including 2 over $1 billion this year.
Wait, I just want to be clear. So you said there were no existential risks to any of your companies, back in March? And if not, why not? Because it seemed like there was an existential risk, in theory at least, to every business.
Yeah, that's a great point, Dan. We have, when in our underwriting process, we are very focused on unit economics. As a growth investor, we have the opportunity to really dig in on the underlying fundamentals of a business when we underwrite them, and we also underwrite to light intentional burn at the point where we're investing. So the companies that we back, fortunately, could dial back some of their investing in areas like CAC and turn profitable, or at least have a very low burn during those scary months at the beginning of the year.
Were you talk about on the growth side of things, did you expect, try to put yourself back in kind of the March mindset, did you expect there was going to be a capital markets slowdown, both in the equity and debt markets?
Yes. That was, in late March and early April, that was our advice to our portfolio companies. And one of the reasons why we told them to pull in the burn was none of us, I don't care what anybody says, none of us had any crystal ball in terms of what the second half of Q2 was going to look like from a capital markets perspective. So our advice always to our portfolio companies is control your own destiny from a balance sheet and a liquidity standpoint, and that rang true, in April and May as well.
Growth equity investors are usually a little bit less, or a little bit more, I guess I should say, geographically agnostic than our early stage investors. But you're sitting in Utah. Utah has become kind of, the so-called Silicon Slopes, but it's had a very good year when it comes to, big tech companies and tech exits. How do you view geography in the view of COVID? In other words, is it an advantage to be physically in Utah, or does it not really matter because you can meet as easily with a Salt Lake City-based company as can somebody sitting in San Francisco right now?
Dan, I love this question, and I'll try to be mindful of how much time we have. I could go on for a long time. Our thesis has always been, for the past 15 years, has always been investing in what we believe are underserved markets from a growth capital standpoint. So investing throughout the Rockies and Southern California and most of the Midwest. And the beauty of what we're seeing right now is a couple of factors, the confluence of a couple of factors. The first of which is, a couple of years ago, you had founders like Jim McKelvey or Arash Firdausi leaving small town St. Louis and Kansas City in their specific instances and moving to the Bay to build unicorns, to build amazing companies. Today's version of Jim and Arash are doing it in the towns where they grew up, and they're so passionate about doing so. And I am as well. I'm a small town Missouri guy too. But you couple that with this phrase, I love this phrase, the exodus that's been happening for the past couple of years that's been accelerated because of COVID and work from home. And that confluence of those two elements has really caused what we believe is going to be an explosive and dispersed entrepreneurial movement in the U.S., across the U.S. So long story short, I think we're going to see a really distributed entrepreneurial environment for years to come.
As an investor, though, as a local investor in the Rockies, do you think you still have the same advantage with that founder that you did pre-COVID? Because if you're meeting over Zoom and I'm sitting in Boston and I'm meeting over Zoom, well, we're both meeting over Zoom.
That's a great point. Great point. I agree with you. Time is now become very efficient. I think what's different, though, whether you're in venture or in growth, and believe me, this is coming from, I've found that perspective is built in context. So I have had the opportunity to build a unicorn in Utah. So this is coming from that perspective. I think how you build a company in these underserved geographies where we spend so much time is different, not harder or easier, but it's different than when you build a company in the Bay or in New York, where resources are at different levels. So I think founders, when they're building these companies in markets like Utah or like St. Louis or like Columbus, Ohio, they're coming at it from a different perspective. They're solving different problems and want a capital partner that is oriented to help them solve that.
Speaking of capital partners, one of the things I find interesting about you is your background, not just with Vivint Solar, which is the unicorn I think you were just referring to, but you also spent some time at the Blackstone Group as a more of a kind of a private equity guy than a growth equity venture capitalist. Blackstone, KKR, basically almost every quote unquote private equity big buyout firm we know of has gotten into growth stage investing, essentially into venture capital investing. I'm wondering from your perspective, is that something that is sustainable and a long-term trend? Or is that just kind of like a lot of these firms did the same thing back in 1999, and then when things got rough, got the hell out of there?
Well said. I'm pretty privileged to have learned finance at Blackstone. So my thinking is the buyout lens that firms like KKR, like Blackstone, they've done a great job of assembling fantastic growth investors. But the lens that they bring to investing is always going to be rooted in that growth, in that buyout perspective. I think that makes it really hard to be a growth investor. Where we're investing, it's all about accelerating the top line, combined with an ROI mindset, which is exactly the opposite in most cases of what buyout does. Buyout is obviously about managing the expense line and getting that financial engineering right on day one. So they're just 180 degrees different. So getting to your point, I think it's a much different mentality, which will challenge these traditional buyout people that are now participating in some level in the growth market.
Joe, I think one of the things that's been so difficult for folks to understand about the capital markets in general, but this is true on the venture side, it's true on the public equity side too, during the pandemic, has been this divergence between capital markets and real economy, kind of financial economy and real economy. You've got very high unemployment, you've got breadlines, et cetera. And yet you have seemingly almost every startup able to start raising at $1 billion. And then, look at DoorDash and Airbnb, but plenty of others this year. This is going to be the busiest year for IPOs in the last 6 years, maybe might even top that, might be a decade high. How do you best explain that divergence?
I love it, Dan. So I think the public markets have adopted a venture mentality, which, and by that I mean, we're not focused on what are the near-term EPS or what are the near-term targets, but more, what is this company going to be worth 5 years from now, given its TAM? And then I discount that back to today. And so I think that's why we have this peculiar disconnect, is investors, public market investors see the light at the end of the tunnel from a COVID standpoint and the sort of the restart of the economy. And then what is that company like a DoorDash? What can they do 5 years from now? And just take the present value of that today. And that's why we're ending up with these valuations that look frothy relative to the breadlines that you mentioned.
I mean, is that dangerous? You're a growth equity investor. You know that while growth stage is obviously de-risked from the seed stage of venture capital, they don't all work. And more importantly, They definitely don't all work at the valuations that they get funded at, particularly in boom times. Is it dangerous if the public markets, usually the private markets follow the public, but you're suggesting it's the other way around?
I am. I think, it is so cyclical. When from investors switching from growth to value, I think that certainly presents a challenge. And if the growth rates can't keep up with market expectations, I think some of these models will be challenged. For us, and I think for most growth investors, it's all about what do the unit economics of this business look like, combined with profitable growth, and by that I mean like an ROI mindset growth. If that doesn't hold true from a public market standpoint, yeah, you could see some carnage pretty quickly.
Joe, final question because we have 30 seconds. So much talk last week, about people leaving California and going to Texas or Florida or Utah. Give me the 30-second pitch for why a tech founder should be going to Salt Lake instead of to Austin.
Great question. So the Utah market has the basis required now to build those great companies. So that from the human capital standpoint, we've got a rich basis of experienced operators in the hypergrowth market. So companies like Qualtrics now, like Domo, they have done an amazing job of pulling in talent from these markets. So these new founders that stand up these companies, they can build their companies quickly with those experienced operators that may not have the same level in these other markets, and it's a very business friendly state.
Joe Kaiser of Mercato Partners, thank you so much for joining.
Thank you, Dan. Have a great afternoon.
You too. And thank all of you for joining today for another virtual conference that has made us all smarter, faster. And a huge thanks to our sponsor, PacWest, Pacific Western Bank, for making this entire event possible. For the latest news, please be sure to follow our dashboard at Axios.com or on the Axios app. And you can sign up for all of our newsletters, including mine, Axios Pro Rata, at signup.axios.com. And before you go, we just wanted to share with you what's coming in 2021 from Axios, which is local. We are launching local in cities like Des Moines, Iowa, and Tampa, St. Pete, Florida. And you can check all of that out at Axios.com/local. Thanks for joining, and we'll see you later at Axios.com.